Hello everybody, my name's Drew Demon and I'm the Devil's Stockbroker. This is going to be another update on the market currently, closing September 27th, that's Tuesday 2022, and right now the SPY has basically closed just a tiny bit lower than our open today. So this session this morning, we actually had a really interesting behavior from the S&P. So this is what the daily chart on the SPY currently looks like, and right now it's setting up lower and lower highs at the moment. The trend overall for the SPY has been getting more and more bearish, with the outlook getting ever more bleak. And I hate to say that this was predictable. This is kind of what we've all been waiting for. And since the SPY is now starting to show clear signs that it is getting weaker by the day, I'm expecting some of the larger cap stocks that have been so far holding up the entire market to finally give way. So I want to kind of put this on everybody's radar so that everyone's on the same page and that everybody knows what to look out for going forward. So on the daily chart for the SPY, clear downtrend since we hit our peak in August. The much larger trend of the market shows that we are still trading in this descending megaphone pattern, which you can see we've had three tops in January, April, and once again in August. And now we are testing the lows that were called out starting on June 17th and now just recently this past couple of weeks in September. Now, a lot of people are calling for a market bounce, and I just wanted to kind of point out that we do not yet have any kind of confirmation that a bounce is coming. We had a really nice gap up this morning, which I called out yesterday, that the market would make a recovery for turnaround Tuesday, but that it would be short-lived. This is exactly what happened. If you go down to the hourly chart, starting from today, first thing in the morning, we had this gap up candle where we put up a new higher open at exactly $368 plus change, and then we tried to make a chase for this previous resistance and immediately got rejected. Back to back, we had two huge wicks on these red candles on the hourly chart. So first thing in the morning started a sell-off. We had a little bit of a fish hook to try to attempt a recovery, but we got rejected again. You notice that these two green candles have very tall wicks, and we ended on a indecision doji candle, which some may interpret as a bullish doji. However, the one thing that renders this bearish is that this doji candle did not break the previous support, this area right here where this last indecision candle was created. Now this candle has set up for a new lower high, which is below a lower low. This is essentially setting ourselves up for more downside to close out the month of September. So right now, nothing is looking good for the S&P. As a result, I, like most of Hell's trading floor, are currently sitting in quite a few short positions in the tech sector. We're mainly watching for stocks like Apple and Tesla to finally give up. But before we get to that, I just wanted to point out additionally that as SPY was going down, HYG was going even lower. What you're looking at here is a ratio chart of SPY over HYG. This is the high yield grade bonds. These are junk bonds for major corporations. I've highlighted this many times in the past, and you'll notice that this ratio chart, which is SPY divided by HYG, is showing continuous downside, and it doesn't seem to be slowing down. And as a matter of fact, we have just recently printed a tombstone candle just today where the high yield grade bonds and the SPY were moving in correlation to each other. However, as the SPY pumped at the very end of the day, the high yield grade bonds continued to the downside. So if we move over to the HYG, we'll see that these never stopped falling. It was just constant downside. We had only a slight indecision doji candle here, but you'll notice that we printed a meteor candle, or tombstone candle, however you'd like to call this one out. This is the this was an attempt to recapture support and get some bullish momentum going in the high yield bonds. It never came, and then we printed on another indecision candle. It does have the potential for turnaround. We are slightly curling out of this channel, but it's still too shallow for us to really have a clear consensus on the direction. So all the signs are continuing to point to bearishness. There's only just this slight recovery in the MACD and the RSI. I'm thinking that if HYG bonds get rejected by the RSI's moving average, then we'll see the MACD reject and cross lower again for more downside movement. So be on the lookout for that. That will signal another move to the downside in the SPY. As of the last several trading days, Apple has been slowly working its way upward. However, it's formed a triangle on a downward trend move. So this downside trend and triangle pattern is essentially just a very small bear pennant, which is part of a much larger bear pennant. And as far as I can see, Apple is continuing to look bearish, although we don't know exactly when it will finally give up. According to this harmonic pattern on the short-term 1-hour chart, there's supposedly some upside potential for Apple to get up to the 158 target. I think that this is a bit lofty, but in the event that the market does somehow pull in a recovery, there's a potential for Apple to get back up to this target. But I would expect a pretty sharp rejection, and this is reinforced by just this one candle by itself. This one green cross candle is enough to tell me that there's no support for Apple at these price levels. As soon as it gets up to 154, it gets slapped down hard. The faith in the stock market is now at an all-time low, and we can see this reflected in the volatility index, which you can see is now beginning to peak over 32.5. And at our high point, we were over 33.7. So we did create a tweezer top pattern here in these two candles. However, you'll notice that out of the double top pattern that we had created here, we did manage to break that pattern, and now we're consolidating on a bull flag. So this new move in the VIX shows that there is likely going to be some support found at $32 even. So for VIX to touch this area before it resumes its ascension. The VIX positions that I have are still very much in profit, and the volatility index is only getting more and more bullish, which is bad for the market going forward. So if you're looking for any kind of signal that the market is essentially ready for there to be some downside, this is your sign. The VIX is now crossed and closed above its descending pattern here on the 1-hour chart, and if we go out to the daily, you'll see that this is part of a larger pattern of tops in the VIX, where now we are now chasing another top here. Now, if VIX closes above 35, that's essentially it. Notice that the VIX crossed and closed above 35 one time on a very massive candle. This was probably one of the biggest daily drops in the market. In the last 5 years. This was February 27th, one of the worst days for the market starting the COVID crash, when panic really started to set in. So this has only so far happened a few times, but every single time that we gap up or cross the $35 level, the VIX crosses very quickly. You get a very huge engulfing green candle. So if you're not in a position on the VIX, it may be too late, but perhaps not. The market's overall just looking really, really, really negative. So I want this to be at the forefront of everybody's mind in preparation for the trading session tomorrow on Wednesday. There's going to be a lot of Fed speakers as well. If you look at the economic calendar, The September 28th, we're going to have Fed Raphael Bostic speaking at, this will be actually 8:35 in the morning Eastern Standard Time. After that, we'll have Fed Bullard speaking at, this is 10 o'clock a.m. And then 5 minutes later, Powell will be speaking shortly thereafter, as well as Bowman at 11 o'clock and Evans at 2. So we have a lot of Fed speakers coming out, and they're all going to be saying the same thing, that the market needs to go down, that they're going to enforce their mandate, they will act in favor of their charter, which is to bring inflation down to 2%, which is not something they're going to be able to do this year, even with all of the rate hikes that they have done. They are going to promise to continue raising interest rates. They are going to fight to keep inflation under control and bring it back down. And this is all going to be negative sentiment for the market, and it's going to talk the whole thing down. So anticipate that the Fed is going to be as hawkish as it's ever been, and this could be an all-out attack on the stock market. Equities are very much in danger, and we can see it reflected in the sentiment of the market. Reinforcing this point, I wanted to bring you to the Fear and Greed Index, which, if you notice, we're currently sitting in extreme fear at 17. This is the lowest reading that we've had since the COVID crash. We haven't actually been here in a very long time, and you'll notice that as soon as the S&P has been moving consistently, where the market has tested ever since January, ever since we crossed below this 125-day moving average. Every single time that we have touched it, we've entered a new leg of selling that has brought us to new lows. Okay, we've touched it and we've hit a new low. So starting in February of 2022, we set up a new low on the S&P down at 4,260. We crossed it again in March, and then by the end of June, we had hit a new low of 3,675. Now we have crossed it again and created a new low, and then touched it and been rejected in September. Now we are getting ready to establish a new low. We still have not broken the lows on the S&P. We've only just barely crossed these lows. We're not quite there. There's a lot of support holding up the SPY in this area. But as soon as we cross and close below these levels of 360, as soon as you see the SPY close below 360, that's it. That's where the panic truly begins. And while this all sounds like extremely terrible hellishness for the entire market and essentially the entire economy, please understand that this is a necessary part of the stock market cycle. And although it's a really difficult market to be profitable and successful in, if you can survive this kind of market, it really shows your skill and your ability to withstand and analyze some of the most difficult conditions of stock market participation that you will ever see. This may in fact be one of the most magnificent, terrible crashes in our recent memory since the crash of the 1980s, and maybe even on par with the Black Monday crash starting in October of 1927. At the very least, what we're seeing in the housing market shows that what we're about to face is at least going to compete for how terrible the 2008 crash was. Some other details to keep an eye on. The put-call ratio is showing that there is extreme fear in the market, with by far a massive number of puts outnumbering the number of calls, with the 5-day put-call ratio being above 1 point. This essentially means that there is at least 2 calls for every one, or 2 puts per call in the market right now. And that's an unusual number. The last time that we had that was towards the end of June, just this year, when we had hit these new lows. The market is anticipating some massive selling. Now, this is a bit of a contrarian indicator. However, we still haven't seen new peaks in market volatility yet. So if we don't see a turnaround in the SPY very soon, then we should expect the selling to continue and for sellers and bears to finally win out. And note that the volume in the market has been relatively low as compared with the pump that we saw in June, July, and August. Moving back over to TradingView, I want to point out the conditions that we're currently trading in. One of the clearest signs that the equities market is no longer a safe place to be to keep your investments is the rapid rise of the bond yields for U.S. government treasuries. The 5-year bonds by themselves have been absolutely surging since we opened up the year in January. The bonds are now up by almost 3% from where they started. We're now up to nearly 4.2% on the 5-year bonds, which is a number that we have not seen since back in 2018, before we had a massive market capitulation crash that wiped out investors in a very short but albeit very quick bear market that swept more than 12% of the equity value out of the SPY. You'll notice that right here, as the bonds had peaked at 3%, the S&P sold off by more than 15. And if you go back even further than that, all the way back to 2006, 2007, you'll notice that the last time that bonds were exhibiting this kind of behavior, where the bonds were just going absolutely parabolic, even forming a bit of a cup and handle type pattern. The last time that we did this was in 2007 through 2008, and as the bond yields peaked at about 5.2%, that's when the market had hit its top, and then all of a sudden the S&P crashed very spectacularly. So safe havens in bonds, or what a lot of investors believe are a safe haven in the form of bonds, what this triggers is a bunch of investors exiting the equities market and then putting all of their money into bonds because they create a safe fixed rate of return. So now that the yields are this high, at a historic high that we haven't seen since at least 2010, this creates a very attractive investment that could lead to yet another evacuation of equity value out of the market, especially in the tech sector, which is extremely beleaguered by zombie companies and extremely poor debt. Going a little bit further into the analysis, the 10 and 2-year yield curve is showing that we have had an even deeper inversion just a week ago. Now we are starting to come back out of inversions, starting to see the 10-year bonds increase at a slightly faster rate than the 2-year. Once again, our current yield curve is still at a historic low that is honestly on par with the dot-com bubble bursting in spring of 2000. So what we're witnessing right now is only just the beginning, because the real crashes that we've seen as the yield curve has predicted them don't truly start until at least 6 to 8 months after yield curve inversion ends. So once we actually see the yield curve coming out of inversion, that is going above the zero level, that's when things truly start to get bad. And at the rate that we're currently going, it looks like we're at least several months from that point. So you can interpret this several ways. You could say that either the yield curve is wrong, which so far has predicted every single recession that we've been in since the 70s, or you could say that what we're witnessing now is only just the beginning. To recap what's currently going on, we go over to the stock market heat map, where we can see that just about everywhere the market is in a bit of red. There's only a few companies that are holding up the stock market, and it's all the largest caps of their sectors. Apple leading the electronic technology sector, Microsoft holding up the technology services sector, Amazon and Costco holding up the retail trade sector, and Tesla holding up consumer durables. Meanwhile, the entire finance, energy, utilities, process industry, transportation, commercial services, and manufacturing and health services are all in the red, deep in the red. And this would appear to be only just the start of what we're about to see, as the dollar index continues to move higher and make stronger moves on the dollar, indicating that inflation is still ongoing as more and more countries leave their currencies in favor of the US dollar, as the dollar reserve currency seems to be holding up its value faster and in greater number than all of the other main European currencies that circulate in the global market. Now, at some point, the dollar will probably stop being a consistent indicator for this. So one other thing that I wanted to put on people's radar is the GLD ETF. This is just a trust that it bases its value off of the price of gold in the commodities market. At the moment, it's moving down with the broader market. However, I do anticipate that this will change at some point in the future as the inflation of the United States dollar gets to be too great, and the stability of US cash as an asset begins to depreciate. We'll likely see a transfer over into gold, kind of like how we did with back in 2009, 2008, even before the big recovery. Starting in March of 2008, gold gave back 30% of its value going into late that year. So starting sometime after the holiday rally, or as our crash starts to get much worse, I anticipate that gold's value will start to move to the upside, and that will be more of a signal of continued downside momentum. Keep in mind that the crash in 2008 continued all the way until March. We didn't see a bottom in the market until March of 2009, and by this point, gold had already been moving up. So the dollar's inflation started to, well, or rather the Fed's decision to ease the market conditions by turning on the printer put a significant emphasis in investment into gold and gold commodities and other precious metals. So if we start to see a big transference from the dollar index into gold, then this will likely signal that we are approaching the culmination of the crash. Our current market is quite a bit different from what we experienced in 2008, so be careful with this. But what I am anticipating is that as soon as we start to see a bottom in the gold market somewhere around the 140 level, then that's probably going to be about the time that the real crash begins for the equities market, and we start seeing gold rip to the upside as the dollar gets weaker. And this will be especially true in conditions where the inflation problem in the EU is resolved, or at least slows down quicker than the United States is able to tackle its own inflation problems. Catching up with the real estate market and XLRE index, we can see that XLRE is putting in a brand new low, and it doesn't really show any signs of slowing down. We've since hit a new lower low since this last move on the 26th of September, and it continues to retreat to the downside. We've now crossed below $36. Currently, XLRE is trading at around 36 in post-market, but I anticipate this to put in newer lows as the housing market continues worsening its conditions while mortgage rates rise and while mortgage applications continue to wane as inventory swells in the market and prices for listing come down in the face of a massive reduction in qualified purchasers or home buyers as a result of the huge rise in mortgage and interest rates. The housing market is far from done crashing, but I think that at the about the time that we start to see houses getting pulled off the market in December, we're likely to see a lot of people giving up on trying to sell their homes at this point. So the market will likely interpret that as improving conditions, which is a mistake in my opinion. But when it does happen, this will probably cause XLRE to at least peter out and start to like go sideways and consolidate somewhere in this price range, maybe as low as $33 or $32. But for right now, pretty much every single contract that I've got is now in the money, with the exception of the 35 puts for January. As soon as we start to see XLRE find its bottom, I will be exiting those positions and looking for XLRE to at least get a recovery, but know that I'm not looking for that bottom at least for the rest of October. I won't even start looking for that bottom to hit until November at the very earliest. At which point, then I will simply just be staying out of the way of the housing market, and I'll be looking to go short on home builders directly, who are likely going to start putting a lot of homes up on sale to try to get rid of some of their inventory, specifically companies such as D.R. Horton, ticker symbol DHI, which is currently being sued for selling mold homes. They are starting to see a little bit of support in their chart, so I'm looking for them to bounce in the short term, and then by sometime in November or late October, I'll be looking to enter into a short position if they see a little bit of a relief rally and bounce, and then short them going into next year. Another way that you can play this is by going short on the nails sector. Nails is a 3 times leveraged, Nail is a 3 times leveraged bullish ETF that tracks the home builders stocks. So this includes D.R. Horton, as well as other major home builders and suppliers such as Lennar, Pult Homes. I think Lowe's is also included in this as a lumber seller. Other guys that do lumber sales and home building materials are also included in this index, all of which are performing extremely poorly. And while you can see that the index is starting to show a little bit of a bottom, it's far from done. Expect a little bit of a relief rally in the short term, at which point I'll be looking to enter into short positions somewhere between $22 and $25, and then short it for the remainder until it finds the bottom of the market sometime next year. And last but not least, we have the IWM small cap stocks, which continues to show that it is undecided whether it's going to drop any further. We have this indecision candle, which closed slightly above our previous day since we had gapped up this morning. However, dividends are now delivering, so at this point we know that any dividend chasers in the IWM will now have no longer got any motivation to stay with the ETF and maybe looking to pull out some of their investment. As a result, I would say be really careful betting bullish on the IWM. As a matter of fact, unless we can get above 168 at least and cross above this level of support in order to start to see a recovery, I would actually expect IWM to reject and create a new lower low and continue this trend to the downside going well into October and possibly early November. We'll see how it goes. But overall, the small cap stocks, which contain a lot of zombie companies, a lot of money losing companies, sadly including companies like AMC, and I think the Russell 1000 includes GME, but a lot of companies that are just not performing. They have a very bad price to earnings ratio, or even negative price to earnings ratio. They're not they're just not performing well. So we're probably going to see bankruptcies coming as lending standards get tighter and more restrictive, and money supply gets tighter in the wake of increasing federal interest rates. So it's kind of up in the air, and you have to really pick and choose the companies on a one-off basis based on what you think will survive this bear market. For right now, I would say the conditions are poor for emerging growth companies overall, and it's probably best just to stay out of their way until we see who the survivors are in this free-for-all that is the stock market for the next several months. Maybe we'll see a little bit of recovery, and some of the stronger ones coming out on top as others fail around them by late next summer. In the meanwhile, I'm going to be continuing to look for entry opportunities in the SQs and the SPXU indexes. These are inverse leveraged ETFs that bet against the Qs and the S&P index. So currently we've seen the SPXU show continued strength as we've been pushing the market as we have been pushing the market further lower. So I am hoping to see that the market continues to drop ever further to the downside, pushing SPXU upward, especially in the tech sector. I feel that the Qs are especially weak and are just now starting to put in. It hasn't quite happened yet. We're waiting for the new lower low to be put in, but we again have created a lower body on this indecision candle, this last candle here that showed that there was some strength in the gap. When it gapped up this morning, it sold off and returned back to the previous day's close, basically closing net neutral on the day, which is still extremely bearish for the Qs, because all the bulls were hoping that this would be able to climb up and above the 280 level and maintain support here. Since that didn't happen, we're probably going to see some more selling here. As well, the MACD momentum indicator is still putting in a lower low and hasn't quite hit a bottom yet. So we're waiting to see just how low it goes. But I would estimate that we're going to probably put in a lower low if this sell-off continues into November and the Qs drop to a previous level of support at around 250 per the pre-pandemic levels. So this would put us at I'm actually overestimating it. It would actually be at around 235, 240 if it were to drop much further than that. So yeah, this would be the bear case for the Qs going out till the end of October. This is going to do it for this day's market update. I look forward to seeing everybody tomorrow at the bell, where we will have a hell of a time in the markets.